All right, so good morning, everyone. My name is Brian Conlon with Meridian Pacific Properties. I'm in charge of business development here. And today is our quarterly webinar where we talk a little bit about the single family residential market and really just want to give our investors an update as to what we're seeing and what we're expecting to see in the months ahead to best prepare our investors and really educate ourselves as to what's going on out there in the market. So that being said, today's going to be a little bit different than our usual format. Being that there hasn't been many monumental shifts in the single family residential space outside of interest rates, we did bring in a special guest speaker, Todd Swanson, today, who's going to be talking in great depths about the interest rate environment and what has ultimately shifted there. On the single family side, we're still seeing incredibly high demand, not enough product for people to get. So that part has really not changed or shifted in the past several months. But with the interest rate environment shifting as much as it has in the past just several weeks, we felt it would be great to bring an expert on board to talk about the mortgage rates or the interest rate environment and the various mortgage options that we have available. Otherwise, the format's going to be pretty similar to how this has gone in the past. Ken Coykendall, our president, is going to be giving us an overview of the Memphis market as a whole. I will continue to talk about the 2022 investor opportunities. Todd will be talking about the interest rate environment and mortgage options. And he'll provide a more in-depth bio, but Todd Swanson is the president of Swanson Lending. He's really seen as a mortgage consultant. The thing that I really appreciate about Todd is that whenever a client or someone gets sent over to him, he takes a holistic view as far as understanding the client's situation, their goals, and then is great at finding the type of loan products or will provide advice to support the investor in finding what's truly right for them. So we're honored to have him on board, and he can provide much greater detailed analysis about the various loan products that he's seen in the market. And then Wendy DeBay, our client relationship manager, will handle our Q&A session, which brings me to the point that if at any time during this webinar you have a question, there's functionality on your Zoom box where you can actually ask a question or type in the chat box. Now, we will be monitoring that during the course of the presentation, but we may not come back to those questions until the Q&A at the very end. So if we move past your question, don't worry, we'll get back to it at the end, but please feel free to use that chat box at your discretion to make sure that we answer all of your questions in the webinar today. So our intention is to be done no more than an hour. But that being said, we can go ahead and jump on into it. So to kick us off, I'm going to turn it over to our president, Ken Coykendall, who's going to give us an overview of the Memphis market. Good morning, Ken.
Hey, good morning. Hey, good morning, everybody. So a little different presentation today. The general metrics of our business are holding very steady, meaning our tenancy rates, our collection rates, our vacancy rates are all very strong. So this morning, we've really been in this unprecedented run up in prices in the last 18 months. And we really want to give you guys a sense of how that's affecting your investments today and how it may affect your investments in the future. And that's part of the reason we brought Todd in, is to really talk about some other options with financing that can continue to make these investments fit your unique circumstances. If we just hop to the next slide here to get going. As mentioned, we've all seen this incredible run up in prices in the last 12 to 18 months. And things we know when that happens, and there's a whole lot of other market forces out there that everyone's trying to predict what's going to happen with the economy, when a recession is going to come. But we're really going to focus on what we know is happening on the ground and what we expect to happen in the next couple of years in the Memphis market. But things we know for sure is, average housing prices went up 18% nationally. This is John Burns' chart of national home price increases last year, 18%. And we also know that rents also always follow housing prices, but just delayed and more moderated. And if you go to the next slide, you can kind of see the historical trends here. The green line is the ups and downs of the housing market in terms of, and this is single family price appreciation. And then you see the more moderate blue line, which is the rents. And yeah, they tend to go up when values go up, and they tend to go down when values go down. There are some exceptions when there's major shocks to the system, as there was in 2005 and 2006. But the trend tends to continue. And what you see here at the end of this John Burns chart is at the end of 2021, by the end of 2021, home prices nationally had gone up about 18%, whereas rents had gone up about 6%. And that 6% in rents for single family residences, that's a blended rate. And if we go to the next slide, last time we got together a month ago, we looked at this slide from John Burns, and this actually highlights how there's two different types of leases, and they have different types of rate increases at a time like this when values are going up. You've got new leases, which is when somebody leaves a property and then it gets released to somebody new. The market gets to respond more quickly to increases in rents because you've got a new tenant coming in and you can respond, you can get the rent up to close to full market value. But then you've got renewals. You know, we know all things being equal, we want to keep our tenants in our properties longer. And so it's a much more delicate process raising rents on renewals. So that was slower to happen. But by the third quarter of last year, renewal rates started going up nationally. And then you see on the far left, you see the blended rates when you put those two together. So this is kind of where the national trend was. They haven't updated this chart for Q4 yet, unfortunately, but this highlights the difference between new leases and renewals. So let's take a look at what's been happening in the Memphis market. One thing that's kind of interesting is the Memphis market, which we've believed in for the last 15 years very strongly, has actually been elevated from a tertiary or third tier market up to a secondary market in the eyes of the researchers. So John Burns now tracks the Memphis data much more closely than they used to. And for 2021 now, rents in Memphis went up roughly at the national average, 6.5%. And as the existing home values went up about 18%. So Memphis in general was tracking right around the national averages. And that's also one of the beautiful things about Memphis. It doesn't fluctuate up and down like other markets can. It's very steady and growing. So that's where they're predicting. Now, how about where have we been? Where have Meridian properties been in terms of rent increases in the last year? This chart shows the last 4 quarters, 2021, and the orange lines are new leases. So as we talked about, in Q2 last year, when we started seeing the elevated price increases on houses, new leases started going up double digits, which hasn't happened in a long time. And this is unprecedented movement. These numbers bounce around a little bit more because we have a 75% renewal rate typically. So these are small numbers. I mean, these are 5, 6, 7 homes that are actually being turned. But then you see the blue line, and these are the renewals. Whoops, hang on, go back. Hang on. You go back to the renewals now, and you see the slight uptick in Q3 and Q4 last year. Now show where we are so far this year. So our numbers are just in for March. So if you pop that next slide up, now we start seeing, well, first of all, we start seeing pretty much consistent new lease growth at about 14%. But now we're starting to see the renewal lease rates increase. And by March, we were actually up above 10%. We have to handle this very gingerly, right? Because it's in all of our best interests, residents, Meridian, and you, the investors, to maintain our residents and have longer tenancy and fewer turns. So we have to manage these price increases very carefully. There's been a lot of difficult conversations with tenants to make this happen. If you go to the next slide, and that can affect our renewal rates, because we want to keep tenants in our properties. The longer they stay, the better the properties perform typically. This is kind of our historical quarterly average over the last 2 years. Q1, we're right about our average, about 75% renewal rate. And then you get into the spring and summer months and people become a little more mobile, right? And our renewal rate hovers around 70%. And in the fourth quarter, people tend to hunker down and our renewal rate is around 85%. So what's happened in this new environment where we're increasing our renewal rates up in the double-digit range? Well, funny thing happened. Our renewal rate actually went up. It spiked up in the Q1 period, which is traditionally around 75%. It was about 81% in Q1. And the reality is, as people are looking around for other properties, they're seeing new leases on new properties increasing at a much higher rate. And as much as they hate to see it, their current lease going up 10% is still a bargain compared to new leases in the rest of the market. So this is a good development, but we are walking a fine line between keeping our tenants satisfied and keeping them in the properties. And so far that's going well, but it is creating a number of challenging conversations with our tenants. But we're going to talk more about why we think this is going to continue. This trend of high renewals is going to continue in a minute. So what do we expect for the rest of the year? This chart shows the green bars are by quarter, all of last year. Again, these are our lease renewals in Q4. It was up around, Q1, up around 8.1%. But we expect that to get up above 10%. In March, it was above 10%. And now we expect that to stay up above 10% for the rest of the year. And while maintaining at least 75% renewals. Our leases are typically 12 to 18, some even 24 months. It's going to take 2 years to work through all those leases. So we're going to see these leases when leases come up. Now, this is a kind of a one-time period where most leases are going to take big jumps in the next 12 to 18 months. So we do expect that to stay up, which obviously will help everyone's returns and will help absorb some of the price increases. These are the new leases. We do expect these to stay above 14% for the rest of the year and into next year. And again, with the higher prices in the homes, these higher rents are required to maintain the cap rates and the returns that we're looking to get for our investors. But it's also important to remember, if you go to the next slide, we shared this slide at our last webinar because it's a very important dynamic in the Memphis market. Memphis is uniquely positioned among most of these markets where the national average over the years of months supply of housing inventory has been 4 to 6 months. Well, right now, for the last 3 months, that US national average has been 2.4 months. In Memphis, it's been less than a month. So Memphis is going through a period of high demand and low supply. And this is where we've been able to go out and secure pretty much 5 years worth of lots that we can build on. The shortage is not just houses, it's buildable lots. And so we've been able to go out through our joint venture development company and secure about 5 years of lots. So we are now building at a 2 and 3 times clip than we were previously, but not everyone's been able to do that. And so supply is still very much constrained as demand is going up. When does that end? And when do houses become unaffordable in this environment? Well, that's the flip side, is Memphis continues to be one of the most affordable markets in the country. This Burns Affordability Index is just basically the average housing cost in the DMA, the greater Memphis area, divided by the average household income. And Memphis continues to be a very, very affordable market. And the only markets that you see high on this side and low on this side are in the southeast part of the country. And Memphis has the absolute best ratio of any of the cities they track there. So limited supply plus affordability does mean there's going to continue to be some upward price pressure. And Burns is still predicting another 5 to 8% increase this year and another 5 to 8% increase next year. How long that continues, we can't predict. That's somewhat dependent upon interest rates and some other forces. But for the foreseeable future, and with the Ford Blue Oval project coming into Memphis, that's going to drive more demand. It's going to build a strong manufacturing base in Memphis that it hasn't had before, creating upwards of 30,000 new jobs in the next 5 years. We feel we're still very bullish on the Memphis market for all the same reasons we always have been, as well as some new ones. So I'm going to turn it back over to Brian to kind of get you filled in on some of those opportunities coming up.
Awesome. Thank you, Ken. All right, so I'll be talking a little bit about what's going on in business development currently as it stands. So from a high level perspective, we have about 90 to 100 homes that we expect to sell this year. We have about 66 remaining to go under contract through the rest of 2022. The majority of those homes are backloaded, meaning that we'll be building those in the second half of the year. So really from July through December, we're gonna have a pretty aggressive build schedule. And which kind of brings me to my second point as far as the fluctuations in build schedule. One of the challenges that we experience on the building side is that it can fluctuate as far as how long it takes to actually build a home. If the winds at our back and everything's moving well, we have good weather, no supply chain issues, et cetera, we can get homes built in as quick as 3.5 months. On the flip side, that delay can be about 2.5 months, where it takes about 6 months to build a home. So as we go through the year, one of the things that we're sensitive to is with how quickly interest rates have been shifting. We wanted our investors to know that there can be some fluctuation in the build schedule based on things that are outside of our control. So while we endeavor to build these homes as quickly as possible, there's just some elements that can push the 6-month time schedule into effect. The other thing that we've touched on briefly that Todd will be going into greater depth and detail on is around the interest rate environment. A couple things have really shifted over the past few months, and different loan products have come to light. So while traditional interest rates are higher than they were a year ago, these alternative loan products are providing some pretty interesting possibilities for investors that weren't there just a few years back. And the last thing I'll say about kind of the business development overview is that we're still moving through our waiting list. Demand for real estate has continued to be high. And if you haven't heard from me yet, but we've had a conversation around, getting you on the waiting list, please know that by the end of the year, I certainly expect to get to you to speak to you, but it's probably going to be through the summer months that I'll have the opportunity to speak to everyone on that list. So that being said, let's talk about the actual opportunities that we have available. So there's really 5 subdivisions in which we're building in this year. The first one, Creekwood in Byhalia, Mississippi, is now officially sold out. For the next several months, the 3 primary areas in which we're going to be building are places Rasco Farms, Mallard Park, Nicole Place. And then in the 4th quarter, we're going to be building out a new subdivision known as Cedar Bluff in Olive Branch, Mississippi. So I'm going to tell you a little bit about each one of these areas and what we find interesting about them. So first one is Rasco Farms. This is a 13-home subdivision, or I shouldn't say 13-home subdivision. We're building out 13 homes in a much larger subdivision. This is an area with decent schools. It's in South Haven, Mississippi, which is an area that we've been investing in since we moved our operation to Memphis back in 2008. So we have a lot of familiarity and experience here. And we also have the added benefit of D.R. Horton is building out a lot of homes, I want to say in that same subdivision and across the street. And what they're doing is they're bringing a lot of attention and interest to that market, which is having the net effect of bringing more marketing to the area, and is actually putting upward pressure on home prices. So we expect our investors, once they get into these homes, to really be the beneficiaries of all this outside work and support that D.R. Horton is doing. So this is a plat map. The thing that's interesting to note about these homes, so right here I actually only show 12 homes. There's a 13th home right here that is not filled in. But these 13 homes right here are all rear load properties, meaning there's this alleyway right behind the homes, and all these homes have rear entry garages. So if you look at the elevation down here, you obviously can't see the garage because it is listed back there. These are all 4-bedroom, 2.5 bath, and they're about just under 1,850 square feet and starting at about $285,000. Next up, Mallard Park. This is one that we've been building in all throughout the year so far, and we'll continue to build into 2023. This is an area that has, it's really been underbuilt, and there's been a strong demand for housing here for well over a decade, but there hasn't been an opportunity to build there until recently. And with all the money that's been invested in the school district in the late, 2006 to 2010 timeframe, there's these wonderful schools, and there's not enough housing and homes around to fill up these schools in the way that they initially envisioned. So while it's a little bit outside of the logistics hub, which I would kind of say is in this area right here, the logistics fields are starting to spill over into Walls, and it's becoming What used to be a semi-rural area is becoming a much more populated area. And right now we're predicting about 25 investor homes to be built throughout the remainder of the year. The plat map is shown here. We're building out all these yellow homes really throughout 2022, when we'll be focusing primarily on these gray homes at the end of this year and into 2023. These are all 4 to 5 bedrooms, 2.5 to 3 baths, and they're about 2,000 to 2,200 square feet on average. And the prices right now on these homes are starting at $296K. All right, so continuing forward to Nicole Place, we have about 22 homes that we expect to build out here in the latest phase for this subdivision. Once again, this is a community we've been building in since about 2014. So I think it's our longest tenured subdivision, and there's still more lots to build. This area has had a huge boom in population, with a lot of those logistics jobs and warehouses, fulfillment centers, et cetera, inhabiting the Horn Lake area, South Haven, Olive Branch, et cetera. Being that the Memphis airport is right here, a lot of those logistics related jobs have been falling into this neck of the woods outlined by my cursor here. All right. So this is just a picture of one of the homes. These homes in gray are the ones that have been built out over the past several years. These ones highlighted in yellow are the ones going to be built out from now until, I believe, through 2023. Some of these will be built out by Meridian, others will be built out by another investor that's primarily doing for sale sales of these properties, just to be redundant. All right, the last community that we'll be building in this year is Cedar Bluff subdivision in Olive Branch, Mississippi. This is right next to our Chateau Ridge subdivision. We're not going to be able to pour lots until, I want to say, the third quarter, and we're not going to be delivering the first homes until October of this year. We expect to be delivering, I think, about it's actually about 10 single family homes for investors this year. On this plat map, you can see that there's kind of 2 different communities bunched together. On the left, we have single family homes, which have larger lots. And on the right, we have townhomes, which you can see shown as these rectangles here. This is a gated community in the sense that there's a gate here and a gate right here. And the single family homes that we're going to be building this year are all going to be on the single family side here on the left. And we're targeting 2,000 to, once again, 2,200 square feet, 4 to 5 bedrooms, 2.5 to 3 baths. So our typical build product, but it's in one of the areas that we covet. I mean, Olive Branch is known for having an incredible school system that's consistently listed as a top 5 city in the United States to call home, based on the quality of life, the safety, the jobs, and the overall community. So that is kind of an overview as to what we have going on in sales. Like I said, if you haven't heard from me yet, if you are on the waiting list, keep that phone ready, because I expect to be in touch with you over the next several months. Now, that being said, I want to bring it over to our guest speaker for the day. Once again, this is Todd Swanson, a mortgage consultant, president of Swanson Lending. And without further ado, Todd, I'll turn it over to you. Thank you so much for being here today.
Thank you, Brian. Kent. I'm a big fan of Meridian Pacific. Full disclosure, I own a couple of properties that Meridian's built. Been very happy with the turnkey experience with that. I continue to be impressed with the values that Meridian has displayed. In my business, I do business by relationship. I don't advertise to the general public. So everybody that I do business with has introduced me by somebody I know. And that seems to be Meridian's model as well. And I've been impressed with that with every client that we've worked together on. So thank you for inviting me here today. My background, I obtained my real estate license in 1993. So I've had a fascination and interest in real estate since, a young adult, and obtained my broker's license as the higher license here in California in 2008. And after a bad experience with a loan officer who lied to me, I looked into what it took to become a mortgage broker. And in 2002, I became a mortgage broker and realized this was where I was meant to be. So for the last 20 years, I've been helping people finance the American dream. In 2006, I became a certified mortgage planning specialist, which is really, it's financial planner training for loan officers. So I look at a mortgage as a financial tool that should be woven into the short and long-term financial plans of my clients, that we should talk about their insurance, even though I don't sell insurance, that we should talk about their investment plans, even though I don't sell investment products. And 2000, I started investing in real estate, and that's, again, part of how I became a mortgage broker. I recently retired in December from the Marine Corps Reserve, and that experience, a little over 30 years in the Marine Corps, colors how I do things, how I see the world a little bit. And so you'll see that probably here in this presentation. Brian, next slide. So I'm going to talk about two broad categories here. The first is mortgage product opportunities, things that have come to market that can help mitigate risk for investors, can help with cash flow. And then the second category there is the interest rate market changes and some strategies around how to handle what's going on with the market. So the passage of the Dodd-Frank law back in, 2008, 2009, I think, bifurcated mortgages into two products. You got qualified mortgages. That's the stuff that Fannie Mae, Freddie Mac can buy. It put strict standards on underwriting, and it limited features that Fannie and Freddie were no longer allowed to offer. And everything else those other features became non-qualified mortgages. Those are products with alternative qualifying criteria. They have some features that are no longer allowed in the qualified mortgage. There's rules on both. In general, I think the positives, there were some negatives to that law, but in general, it made shored up underwriting standards. So the shenanigans that was going on in 2005, 2006 just really can't occur now. So today I'm going to talk about three of those non-QM or non-qualified mortgage products. The first is the debt service coverage ratio. And that product really is designed for qualifying off of the rents off the property. Risk for the lender is mitigated through the equity contribution of the investor and the FICO score of the investor. So got to have a good FICO score. And it allows an investor to go in and do some things that they couldn't otherwise do. So if somebody has more than 10 finance properties, that's a qualified mortgage rule. Fannie Freddie can't finance an 11th property. The debt service coverage ratio doesn't have that rule. It also allows somebody that doesn't have, and dovetailing into the bank statements there too, somebody that doesn't have the type of income that can meet your standard underwriting guidelines. You think somebody that's got W-2 or a business that's highly profitable on, let's say, the tax returns. Some businesses have a lot of revenue. That's where the bank statements come in. We can show that this person has revenue and they underwrite based on 12 or 24 months of bank statements. They don't look at tax returns. Debt service coverage doesn't look at tax returns. It strictly looks at the market value of the rents for that property and how it covers the payment. Asset depletion. This again is another tool for an investor that may have a lot of liquid assets. We can impute an income based on those assets. So just simple math example here. Each lender has a slightly different criteria how they do this. But let's say an investor had $120,000 liquid, and the investor's rule was to divide that by 120 months. That would mean we'd be able to add $1,000 a month to the investor's qualifying income. And some of these products, the bank statements and asset depletion with some of our lenders can be combined. So we can pump up the income on the asset side and show revenues through the bank statements to help the investor qualify. So non-QM products have features like not qualifying with the tax returns. A great example of this would be a business owner that sold their business. They've now done away with their income source by selling the business, have a large amount of assets. That's where the asset depletion would come in. So the non-QM products fit that sort of a scenario. We can also close in a limited liability company. Fannie Mae and Freddie Mac only lend to human beings. They allow more than 10 finance properties, I already mentioned. They have a 40-year fixed, some of these products. So it's an interest rate that will not change. If the investor kept the loan the entire 40 years, the interest rate will never change. And then they offer the interest-only feature. And so my next bullet point there is an interest-only risky? Well, it depends. It depends on how it's going to be used and the product that it's used with. And so what I put there, the fixed or variable, you go back to prior to the financial crisis, interest-only was almost always paired with a variable rate product, meaning an ARM product, meaning something that the interest rate might be fixed for 3 years, 5 years, 7 years. And after that period, the interest rate would become variable. So the investor would now have an interest rate volatility risk. But then also the interest-only period, in some cases, ended at the 3 years or ended at 10 years. And so you could also have an amortization risk with that. And so it depends on how it's used. I like the 40-year fix because there's no interest rate volatility. It's a fixed rate, never going to change. And the interest only period being at 10 years with all of the products I've looked at recently means that the investor essentially, if they pay just the interest only, they slide into a 30-year fixed rate mortgage at rental rates that very likely are higher. There's probably more cash flow in 10 years. So that's one of the benefits of the interest only loan, is that increased cash flow can lower risk. Most investors that I've seen over my career that have gotten into trouble first didn't have sufficient liquidity. They put too much into their investments and left nothing in the bank. And then secondary to that, didn't have enough cash flow. So if you have more cash flow, you can build liquidity, and you can weather any vacancy or damage if a tenant did it, that sort of thing, by having cash on the sidelines. Additionally, and this is unique to the interest only, it creates a higher internal rate of return for the property. And the simple way to think about that is that with an amortized loan, each month that you're making a payment, you're adding to your down payment in a way. So you're growing an equity stake in the property. And so if the property goes up 5%, it's over a growing larger equity stake. And for that reason, an interest only loan can raise the internal rate of return of the investment. Let's go to the next slide. So shifting to interest rates then, this is what's happened. In December, we were running scenarios for clients. I think 25% down, as the slide shows, 3.625, no points. Today, we're looking at 5.5. I just reran it this morning, 5.5 at 1 point. And 1 point is 1% of the loan amount. That's a fee to buy the rate down. If an investor did not want to buy the rate down, we'd be looking at 5.875 today. So rates have risen considerably. So why is that? Well, the Federal Reserve's favorite measure of inflation is the Personal Consumption Expenditure Index. And that, as you see there up in the upper left, has been rising. That's at 6.4%. That's the highest it's been in 40 years. Additionally, with the Fed chart there, what I'm showing is the other thing that the Federal Reserve fears, which is that incomes are also rising at a pretty good pace. They call that wage-based inflation. And if you look at the 1970s, that's kind of what occurred. Prices were going up, wages went up, and it was a vicious cycle of allowing prices to continue to go up because wages were continuing to go up. If wages aren't rising, then prices have a ceiling at some point. They become unaffordable, demand drops. But if wages continue to rise, prices can continue to rise. So let's go to the next slide. So why have mortgage interest rates risen? Well, this complicated chart, it's up because if you follow it, it shows that mortgages are funded by a bank and then sold to Fannie Mae and Freddie Mac. They're then put into a bond pool, sold to investors. Many of us, if we have money market funds or bond funds in our 401k, we own mortgages because they're mortgage-backed securities. That's what the MBS stands for. And in a rising rising inflation environment, the value of a bond investment declines. So investors demand a higher interest rate. So that's the major reason. Now, in addition to that, the major buyer has been the Federal Reserve. What you see there in this chart in the bottom right in red are the mortgage-backed security purchases that the Federal Reserve has been making since about 2009. And if you look at those periods like 2010, 2012, they tapered their buying of these bonds. And then most recently, 2019. In all of those periods, rates began to rise. So just on Monday, the vice chair of the Federal Reserve, that's the quote that she issued. She expects balance sheet to shrink considerably more rapidly. That hurt the bond market. We were looking like we were going to start trading sideways. Let's go to the next chart, Brian. This is the daily trading of the mortgage-backed security as of, I think this is Monday, as of Monday. When this bond chart goes down, interest rates go up. And so as you see, it's been heading down. We had a few days there down in the bottom right where it looked like it was starting to kind of trend sideways. I have a red-green color deficiency, so normally that yellow-orange color would be red, meaning that it traded down on the day. And as you see on Monday there on the far right, after the vice chair spoke, it closed down. And so we're back down into a down trend in rates. So for the foreseeable future, until the Federal Reserve stops jawboning rates higher, we're going to continue to see interest rates rising. Next slide. So that begs the question then, will rising interest rates cause housing prices to fall? The chart you're seeing is from a study that Freddie Mac did in 2016, where they looked at the effect of rising interest rates, and that's in the black there at the bottom, how much the rate went up during those periods. And they compared it against housing prices. And what they found is there's a very, very minimal correlation between rising interest rates and rising prices. And this is something that, I had to think about a little bit, but the Freddie Mac report spelled it out. It's that fewer sellers sell, just like fewer buyers buy. So we'll see fewer transactions in a given market typically because sellers end up becoming buyers. It's not like they're going to pitch a tent next to the freeway, hopefully. Next slide. Looking at it in a more extreme price changes where we've had more than 2% interest rates, just kind of back that up, we still had housing price increases during those periods. So will this cause a recession? Rising interest rates, the Federal Reserve has a long history of pushing interest rates too high, too fast, too far. And what you see there in yellow are periods where the 2-year Treasury bond produced a higher yield, a greater rate of return, than the 10-year Treasury bond. They call that the inversion of the yield curve. And if you notice, the gray bars are periods of recession in the US economy. Every recession has been preceded by an inversion of the yield curve. In some cases, you look at that period in the late 90s, early 2000s, it inverted twice before that recession. What we're seeing on the far right there, you see before 2020, there was a very small dip, but it did invert. And if we go to the next slide, this is the 1-year chart. And you see just this week at the bottom right there, the yield curve inverted again. So this is one of those measures that every recession has been preceded by yield curves. So it's an indicator that we may be at some point 6 months, 24 months out from a recession. It's not an exact science, but it is an indicator saying that we're probably heading to recession. So if we go to the next slide, another common indicator of recession, this has about an 80% probability of being right, is the price of oil spiking in this index. When it goes above that 50 mark, it precedes a recession. And here we've hit that recently with Brent crude spiking. So we've got two indicators that are saying we may be heading into a recession. So let's go to the next slide. Will a recession cause a decline in housing prices? And the answer to that really seems to be, it depends on what caused the recession. 1991, that was really driven by the 1986 tax law change that heavily affected real estate. Prior to that, a doctor, a lawyer could go buy real estate, negative cash flow, and shelter their earned income. The 86 tax law change changed that. It capped the amount of depreciable loss that someone could take and capped the income level that they could take it at. So we started to see a shift in real estate. At the same time, that tax law affected the savings and loans institutions, which is at that period, 40% of America obtained their mortgages through them. So it became harder to obtain mortgages because 2,300 of those institutions went out of business during that period, while there was a disincentive to be a real estate investor. And so by 1991, we also know the Gulf War, we had an oil price spike there. So in 1991, we did see a very small decline in housing prices, really driven by that real estate and banking crisis. In 2008, again, we had a banking crisis, which, simplifying both of those, it became much harder to obtain a mortgage, which means we pulled buyers out of the market, but we still had the same number of sellers. So whereas interest rates affect both sides of the balance sheet, credit qualifying affects just the buy side far more heavily. So going to the next slide. One of the other factors that we have that I don't think we're going to see a decline in housing values is that inventory is at a record low. Kent's chart that he showed earlier went through December. This is through February, and it's 380,000 listings nationwide. That represents a 1.7 month supply based on the number of sales the prior month. That is just unbelievably low. A balanced market is considered 6 months of inventory. So we're heavily skewed to the sell side of the market. Additionally, new construction isn't yet poised to make up that difference in demand. over the last 15 years, we've had more growth in households, more growth in the population than we've had new construction. NAR recently came out, the National Association of Realtors, and said that we're about 4 million houses short of what we need for the population growth. And we've underbuilt for the last 13 years. We've underbuilt that 50-year average. So there's room to make it up. And, so I'm cheering Meridian on. Keep going, guys. Let's go to the next slide there. So the Burns Real Estate Index, I'm going to look at will rents fall? Will the recession cause rents to fall? According to John Burns, with this chart going back to 1985, there was no year that was negative via his methodology. The worst year for growth in rents was 2010. It was 0.3%, not quite one, far less than 1%. If we go to the next slide, this is CoreLogic's methodology. They have a different methodology, smaller sample size of homes. And they saw a 3.9% decline in 2009. That, when you're looking at the homes Meridian is building, rents around, say, $19.50 a month, a lot of these, that represents about a $75 per month decline in rents for 1 year. But you go forward in this chart to 2010, and you're back to a 3% increase in rents. So any decline via the CoreLogic methodology is quickly made up. It was a 1-year dip. So it's pretty true to say that rents really don't decline. Are rising rents and rising home prices sustainable is the next really great question to ask. And what this chart is showing is the income growth from 2010 to 2020 to 2021. Every state in the country saw incomes increase. Vermont up there in the far right is the laggard at 4.5%. But the markets we care about here, because they're Memphis, is Tennessee, Arkansas, and Mississippi. And as you can see, 7.2 for Mississippi, 8.1 for Arkansas, 8.9 for Tennessee. And when I pulled the Memphis metropolitan statistical area, it was about 7.2 for that whole metropolitan area. So that's a strong growth in income. And there's a rule of thumb in the mortgage industry that if housing prices go up 5%, you need median income to go up about 1% for that 30-year fixed payment to stay in ratio, to stay affordable. So the fact that we're growing at 7.2% says there's plenty of room for rents to rise as well as prices. All right, so conventional wisdom says that interest rate is the most important factor. I hear that a lot, in quotes that clients get, get this rate, do this thing. That's the most important factor. But when you look at how mortgages are priced based on that logic, then Fannie Mae considers the lowest risk mortgage, the best price mortgage, one that's 60% loan to value or lower. So therefore, by that logic, investors should put 40% down every time. A 15-year fixed mortgage is also a lower rate than a 30-year. And of course, there's the maximum buy down, paying 2% of the loan amount to buy that interest rate down. But saying that out loud to investors, kind of nonsensical, because it ties up a ton of capital. It lowers the investor's rate of return. So interest rate is not, in a lot of cases, is not the primary factor, and in some cases may not be very relevant in the decision matrix. So let's talk about some strategies. Let's go to the next slide. Talk about some strategies on how to deal with the current rate environment and rates continuing to rise. The first one that jumps out to me, over the years, a lot of investors that I've spoken to aren't doing tax planning around the real estate. They're kind of letting their tax preparer prep their tax return. They don't know about cost segregation. And that's just one specific strategy. But to dive into that, that's taking some of your depreciation, a big front load of your depreciation up front. So an investor that has other properties that are heavily cash flowing, they can buy a new property, do the cost segregation, get a big bunch of depreciation up front, and cover up that positive cash flow, get it tax-free from those other properties. Which means when you look at your blended portfolio of investment property, you create a higher rate of return by doing that, by doing some tax planning. So that can mitigate any rise in rates. Larger down payment, even if it's temporary. We're seeing housing values go up considerably. Zillow, which I almost need to say this tongue in cheek because their model of valuing homes isn't so accurate, but they're calling for an 18% increase in housing values nationwide this year. They just put that out last week. Other metrics, NAR, being that we're 4 million short, I do think that's probably there. So any larger down payment could potentially be refied out later, but that would be a way to manage the cash flow. You could buy down the rate. When I was pricing that out, a traditional buy down normally paying 2% of the loan amount would only get a 0.5 point reduction in rate. In this current market, I'm seeing a 3/4 reduction there. So 5.5 versus 4.75. There's an opportunity there. Consider alternative products, whether it's the 40-year fixed, the interest only. In some cases, I've seen some ARM products, 7 or 10-year ARMs. These are 30-year loans where the rate's fixed for 7 or 10 years. And if that meets the investor's time horizon for ownership, that could be a good product. So look at alternative products. And then be prepared for rates to fall. And really what I'm thinking there is in recessions, interest rates decline. So as you're planning your business, a sale of a business, you're planning your other investments, you're moving money around, keep an eye to being able to qualify for the mortgage you want if rates do fall, if we do fall into recession, which I do think we will, and rates fall in a recession. So I believe there will be opportunities to refinance during that period. And so be prepared for that, because while you may have an interest rate on the acquisition now that you're not thrilled about, there'll be an opportunity to get a lower one in the future. Interest rate's only one factor in determining payment, and payment is only one factor in determining rate of return. Other considerations that may trump the rate are that the constraining factors of the investor. So for example, in the earlier example I gave about an investor who sold his business, has a large amount of assets, getting the loan and in this environment where housing values are going up, where rents are going up, that may trump any concern about, did I get the ideal interest rate? Did I time the interest rate market perfectly? If you're going to make a profitable investment, make the investment, and the interest rate is what it is. Time horizon's another factor. We're not day trading with real estate. It doesn't go up and down 30% in a day. These are longer term investments. They're illiquid investments. So looking at them as Meridian does over a 10-year time horizon, I think is a good lens to look at it. And in the short term, while we're experiencing inflation, remember, real estate is historically a hedge against inflation. So I think I covered where interest rates are at. I covered some alternative mortgage products. So I'm gonna turn it over back to you, Brian.
Awesome. Hey, thank you so much, Todd. That was fantastic. Let's go over to Wendy, and I think we have one question here in the chat box, but turn it over to you for the Q&A session.
Yeah, actually, Brian, I don't see any questions right now, so I want to open it up if anybody is interested in asking any questions of anybody on the panel. Please type them in the chat box and I'll be happy to direct them to the appropriate executive here.
Perfect. And while we wait for people to type in information for that, folks, you're welcome to reach out to me if you wish to get a hold of Todd or speak to him about your specific situation. But Todd, what's the preferred way for people to get in touch with you if they're wanting to follow up and inquire more about what you shared today?
Email's great. It's my first name, Todd, Todd, at swansonlending.com. I can put that in the chat board. If I put it in the chat bar, does that everybody see that? Okay.
Yeah, we can also include it in the information that we send out as a follow-up to this presentation.
Yeah. And then, with an email, my assistant Donna, processes my email daily and manages my calendar. So she would get you on my calendar for an appointment to discuss the specifics of your situation. We believe that prescription without diagnosis is malpractice. So, we really want to understand your goals, what you're trying to achieve, before we give any prescriptive remedy, if you will. And so that's what the initial consultation would be about, is just getting to know your goals and how we can help.
Right. That's perfect. Well, yeah, if we don't have any more questions, obviously feel free to reach out. Oh, Wendy, looks like someone.
Yeah, I do see one from Tim here. Hi, Tim. How many people are on the waiting list for homes at this point, Brian?
Right now, we have about 90 people on our waiting list. Nice, quick answer. If you have any more questions, please feel free to type in, but otherwise I'll kind of start the wrap-up process. I first just want to say a special thank you to Todd for taking the time and really providing this, fantastic education about what's going on and what you're observing in the interest rate environment. I know it's caused and created a lot of uncertainty amongst investors, and just appreciate your data-driven approach to really understand what's going on and then also to predict what could happen in the future. So absolutely invaluable. Yeah, Tim, to answer, it's about 90 people on the wait list currently. And I believe I actually added you many months ago, so you're much higher than that. Also, a special thank you to the panelists. Wendy, as always, appreciate your support, processing, making these webinars go, and everything you do to really support our clients. And certainly to our president, Kent, just thank you for taking the time and really, shining the light on what's actually going on out there in Memphis. I know you visit out there every month and really manage and lead that team so effectively. So appreciate all that you do for that.
Hey, Brian, I've got a question. That's because I've got a couple people that I'm going to be introducing. How long out, if they're getting added to the bottom of that list of 90, how far out are you estimating now that before they'd be looking at buying?
That's a fantastic question. Unfortunately, I'm going to give you a rather ambiguous answer. I would say I would be in touch with them by the end of the year, but right now it'd probably be a Q4 timeframe as to when they could expect to put something under contract. The thing about having the waiting list as long as it is, we started creating that list well over a year ago, meaning a number of people that are on that list may no longer be interested. But there's also people on that list that may be interested in buying, 7 homes in one fell swoop. So being that we're going to be building almost 70 homes for the remainder of the year, I expect that we'll get to the people on that list probably in the September, October timeframe to discuss options. That's what I'm telling people now, knowing that there's going to be some inherent fluctuations, just depending on what happens over these next several months.
Okay, cool.
All right. If there's
Don't have
nothing
any
else,
other
guys.
questions.
Perfect. Thank you,
I was just
Wendy.
saying no
Well,
other questions. Yeah.
thanks. And certainly a special shout out and thank you to all of our investors. We really appreciate your continued trust and faith in us. We certainly do our best to do right by you all. And it's for you guys that, that's the reason we do what we do. So thank you again for the trust. Please reach out if you have any questions, comments, feedback, anything of the like, as we're always interested in improving and doing right by you. So that being the case, we are done. Panelists, any final remarks before we hang up?
I don't think so, Brian. Thank you. That's
Yeah.
very
Thank
informative.
you.
Todd, thank you. That was very educational.
Thank you.
Yeah. Thank you, Todd.
No, you'll get an email.
All right, everyone. Well, I wish you a fantastic rest of your week. Happy April, and we'll see you again in the first part of July. Take care, guys.
Thank you.